Welcome to the first video of Chapter 8. Chapter 8 is about investment criteria. Companies will use the investment criteria to evaluate whether an investment project is worth initiating or not. If an investment project is a good project, making a profit, then the company should initiate the project. Two criteria that we will focus on in this chapter are the net present value and internal rate of return. So we will talk about the definition of the net present value and internal rate of return, and we will talk about the relationship between the two. And then in the next video, we will talk about the applications of these criteria using the mutually exclusive project, and also we will talk about different pitfalls of internal rate of return. Okay, so first let's talk about the definition of a net present value. To talk about the net present value, we need to talk about the opportunity cost of the capital first, because net present value basically is a present value calculation, and we will use the opportunity cost of the capital, whose definition I don't have to explain. We will use the opportunity cost of the capital as a discount rate for the present value calculations. So the definition of the net present value is the present value of cash flows generated by the investment project minus the initial cost of an investment project. So net present value is basically the present value of the positive cash flow created by an investment project. So when you look at the technical definition of the net present value, you will find that this is really not, this is really similar to all the present value calculations that we have seen before. So net present value is the sum of initial cash outflow and the present value of all the future cash inflows is generated by the investment project. And we use the opportunity cost of the capital as a discount rate to discount the future cash flows into a present value. Okay, so let's go over a numerical example. So this is an example from your textbook. You spend $1,000 today in this investment project. Then you are expected to get 2 payments of $600 each year for 2 years. Okay, and the opportunity cost of the capital is 10%. So what it means is that if you do not invest in this specific project and invest in an alternative project, then you can enjoy up to 10% return annually. Okay, so given this information, what is the net present value of the project? The net present value of the project is, again, the difference between initial cost of the investment project and the present value of the future cash inflows generated by the project. And we use the opportunity cost of the capital as the discount rate. So in this case, when we calculate the net present value is $41.32. Think about what it means. What it means is that if the company invests in this project, then the company will make $41.32 more than the alternative project that generates 10% return. So if the company actually invests in this project, the rate of return from this project should be greater than 10%. That's what it means. Okay, let's go over one more example. So the second example is pretty similar to the first example. The only difference is that in this case, you will receive $1,200 in 2 years. So you don't get any money in the first year. You get all the money, $1,200 in the second year. And, because we learned the concept of the present value calculation, and we know that money today worth more than money tomorrow. So we should expect the present value and the net present value of this project to be lower than the first case. Okay. And again, the opportunity cost of the capital is 10%. So what is the net present value? The net present value of this project is negative $8.26. Right? This is actually pretty surprising. Why? Because this project is not a terrible project, right? Because you spend $1,000 and you will get $1,200 in 2 years. So by no means you lose money by investing in this project. So why is the net present value negative? The reason is because the opportunity cost of the capital is 10%, right? So instead of investing in this project, if you invest in an alternative project, how much money will you have in 2 years? So you invest $1,000, right, and earn annual return of 10% for 2 years. So in 2 years, you will have this much money. So 1.1 squared is 1.21. So you should have $1,210 in 2 years. So investing in an alternative project is better than investing in this specific project. And that's the reason why the net present value of this project is negative. Okay. And at this point, you may wonder, hey, why the difference is not $10? The reason is because this is the present value and this is the future value, right? So if you calculate $10 over 1.1 squared, you will get exactly $8.26. Okay. Now, let's move on to Excel and see how we can use Excel to calculate the net present value. Okay, so this is the basic setup of the previous question, the previous example. So the discount rate is 10%, and when you invest in this project, you will spend $8,000 today, and you will receive $600 in 1 year and $600 in the second year. Okay. To calculate the net present value of this project, all that you have to do is press enter and type in NPV and open up a parenthesis. Then you will see the information that is required by the Excel. The Excel asks for the discount rate information, and discount rate is here in cell B1, right? And in this case, you want to lock the reference cell. So we lock the reference cell and comma. Then all that you have to do is to highlight all the future cash flows. Okay. But at this point, you do not want to highlight the cash flow in year 0, because net present value function in Excel always assumes that cash flow starts from year 1, not from today. Okay, so if there's any cash inflow, outflow happen today, you do not want to include that in the Excel NPV function. Instead, you close the NPV function and add today's cash flow back to the net present value. Okay, so press enter. Then you will see that the net present value of this project is $41.32. So let me just copy this and show it in here. Okay, so this is how we calculated the net present value of a project. Okay, let's do one more exercise, right? So the second project had the same initial cost, but in year 1 there was no cash inflow. In year 2 there was a cash inflow of $1,200. And in this case, because we already set up the NPV function in this cell. All that we have to do is to hold this and scroll it down. Okay, then you will see that the net present value of this second project is negative. So if the opportunity cost of the capital is 10%, right, then the company should prefer the first project to the second project, and the company, when it initiates the first project, will make the extra profit of $41.32. All right. Another investment criteria that is widely used is the internal rate of return. We have used the internal rate of return for some time now, but the technical definition of internal rate of return is that it is the discount rate that makes the net present value equal to 0. Right? And we use the internal rate of return because it tells us the periodic rate of return of any investment project. So in many cases, when you have annual cash flows, internal rate of return provides annual rate of return for an investment project. So let's review an example. So again, this is from your textbook. Let's say you can purchase a building for $350,000. Okay, and this investment will generate $16,000. So this is basically the rent in cash flows for the following 3 years. Okay, then at the end of the 3 year, you will sell the building for $450,000. Okay, so this is a 3-year project. When you make this investment, what is the internal rate of return of this investment? Okay, so we can answer this question by solving this problem, right? As I told you before, the internal rate of return, right here, is the discount rate that makes the net present value equal to 0. So you can see that this entire equation is basically the NPV equation, right? So the internal rate of return is the value of R that makes the net present value equal to 0. Okay. So when we actually solve this problem, the internal rate of return of this project is 12.96%, which means that if you're a company investing in this project, over the 3 years, annually the company will make 12.96% return. Okay. Now we can actually solve this problem using Excel, and this is basically the format of the Excel for the internal rate of return, and we can actually go here and do an exercise on the internal rate of return function. So this is the basic format of the example that we just went over, right? So the internal rate of return of the project is 12.96%, as we can see here. There's one thing that I want to emphasize. One of the common mistakes that students make is that when they use the internal rate of return function, they calculate the present value of these future cash flows first, and then use the internal rate of return function of those present values. Okay, that's a mistake. Okay, so when you use the internal rate of return function, make sure that you highlight all the future cash flows and the initial cash outflow. You do not want to discount these future cash flows. Okay. Now, is this a good project? we know that the internal rate of return of this project is 12.96%, right? But that really doesn't answer the question. So if we want to make a decision on whether this is a good project or not, we have to compare the internal rate of return of this project with the discount rate. So for example, if the discount rate of the company or the opportunity cost of the capital of the company is at 10%, then this is a good project because the internal rate of return of this project is greater than the opportunity cost of the capital, right? So, for example, when we calculate the net present value of this project, right, using the 10% discount rate, and as I told you before, do not include the initial cash outflow in the NPV function, okay? And after closing the NPV function, just add the initial cash outflow, okay? So when we calculate the net and the NPV, when we calculate the NPV, we see that the NPV of this project is $27.88. Okay, so what it means is that when the company initiates this project, the company will make a total profit of $27.88, right? Now, we learned that the internal rate of return is the discount rate that makes the net present value equal to 0, right? So let's see what happens when the discount rate actually goes up. So when we change the discount rate from 10% to 11%, you can see that net present value actually goes down, which is kind of obvious, right? And also you can see that when the discount rate is actually equal to the internal rate of return, the net present value is equal to 0. Okay. So we can see that the net internal rate of return is the value of R that makes the net present value equal to 0. The reason why it works like this, and the internal rate of return and the net present value have such a relationship, is because in normal cases, discount rate and the NPV has monotonic inverse relationship, as we can see in this graph. So this is the discount rate, right? The horizontal axis is this discount rate, and the vertical axis is the net present value. So what we can see here is, as the discount rate goes up from 0 to 5%, 5% to 10%, 10 to 15%, the net present value, which is captured by these points, goes down, right? And as we saw in the previous calculation, when the discount rate was at 10%, net present value was about 28, right? So what this means is that because the net present value and the internal rate of return, because the net present value and the discount rate has monotonic inverse relationship, when the discount rate is less than the internal rate of return, which is the discount rate that makes the net present value equal to 0, right? So when the discount rate, market opportunity cost of the capital, is less than the internal rate of return, NPV has a positive value. So any project that has a positive NPV has internal rate of return that is greater than the discount rate. So usually the NPV criteria and the internal rate of return criteria agree. So if there is a project that has a positive net present value, then it is likely that the project will have the internal rate of return that is greater than the opportunity cost of the capital. Okay, so that's the reason why these two criteria are used widely and often used interchangeably. However, there are certain cases in which the internal rate of return can tell us a different outcome than the net present value. And that's what we call as the pitfalls of internal rate of return. And we will cover that in the next video. And hope you enjoyed this video.